in this case, if you know exactly your forex game, the volume in the market based on all these different types of things that I've spoke about, the sessions and the fundamentals. Great. Hi guys. I hope you're having a wonderful evening. So we have started with our meeting. What we're going to talk about today is the common mistakes to avoid in forex trading. By the way, my name is Marvin. I'm from South Africa. No, we're currently based in the UAE, so hopefully this is gonna give like a lot of you awareness, because I think mainly we focus on charts, trading, how we flip accounts, but we forget the simple things like common mistakes to avoid in forex trading. So this is the topic that we're gonna touch on today. It's not gonna be long. We're gonna try to keep it as short as possible, and yeah, let's get into it. So what we're gonna do is now I'm gonna explain to you on the first slide. So what we're gonna talk about right now is over trading. What is over trading? So key points definition: trading too frequently or with too large positions, often driven by emotion rather than strategy. you know. So what happens is most of the people are trading, like frequently. And another mistake we do is when you're trading, sometimes you are pushed by the emotions. You are trading, but you're thinking of mainly the social media influence, or I'd say the pressure. You see people online, they're posting beautiful cars, they're doing all these wonderful things. And now, if you're putting that on your trading without a proper trading plan, or like a proper trading discipline, we're talking like your target per day, you need to set like percentages that, okay, in a day, maybe I'm doing 10% from the initial deposit. This is what I'm gonna do. You need to have like your Excel sheet where you're gonna have your proper numbers until you reach the target. That helps you with discipline. But if you're trading on a daily basis, you want to be trading based on the emotions, based on what you see on social media, it's not going to be good for you, because at the end of the day, you end up doing one of the common mistakes that we are currently touching on today. So why is it a mistake over trading? Over trading increases transaction costs, risk exposure, and often leads to emotional decision making, which is what we've spoke about right now. So solution: stick to your trading plan and set clear entry and exit point. Like, that, okay, today I'm only going to be executing two, three, four, or five trades, and this is the target for the day. This is the volume that I'm going to be using, and this is the asset class that I'm going to be trading. So I will be trading gold maybe during Asian session, or maybe let's say during US session, and this is my target. You know that, okay, this is my lot size for certain points, and the aim for all that is just to reach 10% of the initial deposit for day for today, and for a certain period of time. So you know that if you're setting, let's say, 15 days, and you want to reach like 10% daily, you know that if your target from $2,000 deposit is 7,000 in 10 days, it means you need to make 10% every single day. In this case, you have a plan and you are trading according to the plan, according to the target, and according to the percentage. This will limit the risk of trading based on emotions. So we're gonna move to the third uh, slide. So what we're gonna touch on right now is lack of trading plan, which is what I think we've mentioned a bit on the previous slide. So key points definition: trading without a well thought out strategy that includes risk management, goals, and the criteria for entering, exciting, and exiting trades. Why it's a mistake? Without a plan, traders are more likely to make impulsive decisions based on market noise and emotions. Solution: develop develop and strictly follow a detailed trading plan. Regularly review and adjust it as needed. You understand? So what happens is lack of a trading plan. Mostly people get into the market like if you don't have like a trading plan. One common mistake is that you don't look at your fundamentals. There's high impact news events. You know, we've got your NFP, we've got your CPI report, we've got your FOMC, you know, and we've got different types of sessions. We've got Asian session, we've got US Open, we've got London, and all that. And now the volume in the market based on all these different types of things that I've spoke about, the sessions and the fundamentals, is that if you don't have a trading plan, you don't know if there's news events that will happen. You don't know if it's Asian session or it's US Open. You don't know nothing. Hence, we go back to there would be noise in the market, and you don't actually understand why there's so much volatility in the market. So, if you don't have a trading plan, in that case, it means you are not planning your fundamentals nicely. You are not checking if there's fundamentals in the market. You are not checking the sessions because the volume or the volatility in the market occurs based on the sessions. When it's US Open, everyone knows that the market is volatile. There will be like a very volatile candlestick that would open. You know, during Asian session, everyone knows that the market is accumulating, is slow. You know, like the market is not moving that much. There's so much volatility in the market. When there's NFP, the non-farm payroll, which is the news events that happen every first week of the month, there's a lot of volatility. So if you don't have a trading plan, you get that the news happen and you are in the market, you're trading, you are over trading, you know, you are doing mistakes like uh, going back and forth, opening trades and closing them without having like a solid target for the day. And that can lead to losses. You know, these are the common mistakes that people, you know, do in trading. So lack of a trading plan is something that we need to be looking at. People need to create like a solid trading plan before they trade. You don't just get into the market, you're buying, you're selling, there's volatility in the markets, you're blowing accounts, you don't know exactly what you're doing. So create your trading plan. It's a typical example: when you build a house, you need a plan. You need to start first by the foundation, then you lay your bricks nicely until you get to the roof. It's the same thing as trading. You need to have like a proper plan. Know that, okay, today is the first Friday of the month. We have NFP. The market will be volatile. So what I'm going to do is I'm going to be trading based on 1, 2, 3, 4, 5, using my proper risk management and technical analysis. And I'm only going to be making 10% of the initial deposit for the day. That's discipline. You have your proper risk management. You applied your stop losses and take profit targets, and you know that in that case, whatever that happens, it happened according to the plan. So you need to plan everything you do. All right, I hope this is clear. So we're gonna move now to the last one, which is ignoring risk management. Key points: definition. Failing to set a stop losses, using too much leverage, or risking too much capital on a single trade. Why it's a mistake? Poor risk management can lead to significant losses that are difficult to recover from. Solution: always use stop losses, limit leverage, and never risk more than 1 to 2% of your capital on a single trade. One common mistake that a lot of people do is, I've seen that there's a culture that has developed. People tend to barcode, they open multiple positions on one price, and they don't put proper risk management. And there's another common mistake of not looking at the capital and wanting to open big lot sizes on a trade, with a small equity. This is one of the biggest mistakes. The people tend to think that from a small deposit they can make a huge amount of money, and by using big lot sizes they can be able to flip small accounts to millions, and which is, if you do your calculations well and you are checking like your risk versus reward ratio nicely, you will then realize that if you're using big lot sizes with small amounts of money, it's only luck that you will be able to make profit, but in most cases you end up over leveraging and losing your account. You understand? And in that case, if you are using that culture, it means you'll be depositing small amounts and losing them, because I mean, if it's luck, it's gambling. You might over leverage your account, make money now, but on the next trade you lose all the funds that you have made. You tend to lose all of them. So it's really important to calculate your equity and know that if I'm having, let's say, for instance, 100,000 USD, I need to, this is the lot size that I have to use, because if you're going full margin on $100,000 account and you're opening big lot sizes, one slight move, if there's volatility in the market or during NFP, one slight mistake, you wipe out. So risk management goes hand in hand with a proper trading plan. You need to always use a calculated risk based on the funds that you have in the account. This is very important. And if you can have a pen and a paper have your Excel sheet all the time, calculate your percentages, know your targets on a daily basis. Trust me, you will last long in the market and you will see progress and you'll be able to reach your targets. Trading, you need to treat it like any other business. When you open a business, you know that okay, this is the amount of money that I'm going to be using to start the business, and if I'm selling this much, this is the profit I'm going to make, and from the profit, this is going to go to the savings, and this I'm going to use to grow the business. It's the same thing as trading. You need to use proper risk management so that you can be able to jot down every single profit percentage that you're making. That will allow you to plan your growth. But if you're just getting into the market, you are overly leveraging, you're opening big lot sizes, you don't have like a proper plan and the direction of where you're going, this will then get you into trouble. You might get stuck along the way because you don't have a plan. You don't know where you're going. So now, risk management and a proper trading plan goes hand in hand. Do your trading journal all the time. Always back test. Know your trading timings. Know your trading fundamentals. Know your trading sessions. Asian session. What is the behavior in the market during Asian session? US Open. What is the behavior in the market? You need to understand the behavior of all the fundamentals. How does CPI behave? Well, how does the market behave when the CPI? How does the market behave when there's NFP? How does the market behave when there's FOMC? All those things are very important. Know your trading as much as you know yourself. In that way, you would be able to see progress and growth in your trading. We do offer this webinars constantly, and we're giving out awareness and education on our social media platforms. If you can go to TNFX on Instagrams, there's topics about different types of trading, and there's a lot of educational content that is uploaded there. So if you can visit our social media for English content, you would then see videos about different types of accounts, different types of trading strategies, the do's and don'ts, and also the topic that we've touched on today that speaks about the common mistakes in forex trading. And in this case, if you know exactly your forex game, you know how to calculate everything, the spread difference, the price difference between two pairs, all those things. All the behaviors of your asset classes and all those things. This helps you to grow, and the common mistakes that we have spoken about, they don't get a chance to disrupt your trading journey. Trading is a beautiful thing, but you need to focus, understand it, and forget about just thinking about flipping accounts, making a lot of money. You need to focus on education, then money will come. You understand? So we're gonna have more webinars touching on topics that are really educational so that people can get motivation into this trading space. So I think we're gonna close on this one. The topic for today was just a short one, common mistakes to avoid in forex trading. So I would like if you guys can take time, have a pen and a paper, try to journal everything, do your trading plan accordingly, set your target. When you make a deposit, you know that, okay, I'm making a deposit of $20,000, and I'm only going to be making 10% of the initial deposit daily, and I'm not trading, because over trading can lead to emotions, and you can end up getting distracted psychologically and end up making wrong trading decisions. So if you have a trading plan, stick to your trading plan. If you have trading target percentage, stick to it, and make sure that you are following that, and you will see success in forex trading. So thank you for joining in. I hope this really helped you, and I hope you would come join us on the other webinars that we're gonna be initiating. We're gonna be having like a lot of topics that we're gonna touch on. The main aim is to make sure that we give people trading education as much as possible, because trading is a beautiful thing when people are doing it the right way. So let's get together, make sure that we focus on education and knowledge, and in that case, in TNFX would have like a good trading community. TNFX is a broker for you. If you need any help, we are here. We've got a lot of account managers, that speak different languages, and you can get in touch with us and would help you to grow. Just make sure that you have an account with us. Open an account, keep your account with us, and make sure that your account grows. So I think we're gonna end this one, and hopefully on the next sessions that we're gonna have, we'll have as many people joining in as possible.